Well, hello, this is Steve Sanangelo once again from the SRS Rock Report, and I'm glad you're here today because I've got a very interesting update on the silver market as well as the stock market. And I believe the silver price is set up the best I've seen in years, if not decades. I'm going to discuss that as well as what I see as the massive correction that's underway in the Dow Jones. So let's get started. Now, I published this chart in one of my previous articles, but I wanted to start here. This chart of the Dow Jones Index was published on March 19th. This is the trading was March 19th. And at the time, the Dow Jones was trading at 24,661. Now, I said the next level, the next big level is going to be 19,000. And the reason for that is it's 50-month moving average is about 19,000. Now, once it falls below that, I see it going down to its 200-month moving average in red, which is 13,000, and it will fall even lower than that. But let's take a look at the more recent chart, and I'll show you what's been going on. In January, the Dow Jones hit a peak of 26,600. It then had 2 weeks sell-off, and we could see here in this week, it fell very low, but then it didn't close. It came back up, and on Friday, it closed here of that week. And over the next several weeks, the price of the Dow Jones was going up and down. But now in these past 2 weeks, especially this last week, it fell 1,200 points. So the Dow Jones, as of March 23rd, is at 23,500. It's 12% lower than its peak in January. Now, as I said, I do believe its next stop will be 19,000. And when it gets to there, it'll be 28% lower. But I see the Dow Jones falling much lower, even a 50% correction and worse. So that's how I see it over the next 2 years. Now, the reason why the stock markets are severely overvalued are because of stocks like Netflix. Now, Netflix, and this chart was done on March 19th when Netflix was trading at 310. As I mentioned in the article, since the beginning or the end, right at the end of 2017, beginning of 2018, Netflix has increased from 190 up to 310. This resembles, as I made a joke, it looks like the antenna on top of the Empire State Building. This kind of a setup isn't something that remains that long. And I'll tell you why, because we're already seeing in just a week or 4 days since I published that chart, this is now March 23rd, Netflix has sold about $10. It's now at 300. So again, once we get below the 190, I really think we're going to sell off, because if we go back to 2012, Netflix was selling at $10 a share. It's now at 300. And the reason why Netflix is severely overvalued, it's by its fundamentals. And we could check that by looking at its cash flow statement. Now, I always look at the cash flow statement because it gives a more realistic idea of what is taking place in the company. Now, on top, they start with the net income, then they add all these different things. In 2015, Netflix made $122 million net income. It was 87 million in 2016. And then it jumped to 559 million in 2017. And part of that was due to the Trump tax cuts. But because Netflix has to purchase all their streaming content, they're purchasing shows and movies, they pay a lot of money for that. Now, right here, it says net cash used in operating activities. It's all negative. Because they weren't making money, they had to borrow the money. And in 2015, Netflix borrowed 1.5 billion. They borrowed 1 billion in 2016 and a little more than 3 billion in 2017 for a total of 5.5 billion. But that's not all. This next line shows you what they made from the issuance of Netflix stock. And over these 3 years, they made an additional 203 million in new issuance from their stock. So this Netflix PE ratio, which is at price to earnings, is 245. I mean, that is ridiculous because Walmart is about 25. They're 10 times Walmart, and Walmart is actually making money. Now, when you add debt, it ends up on your balance sheet. Now, I went back to 2014, and in 2014, Netflix, their total long-term debt was 885 million, and now it's 6.5 billion last year. So even though Netflix is supposedly making some money, they made a little more than $500 million. How long is it going to take to pay off that 6.5 billion in debt, which has increased almost 7 times? So Netflix really isn't making any money. They're adding a lot of debt because it's very expensive to pay for these content. And so that's the reason why I see the value of Netflix crashing along with the stock market over the next several years. Now, I want my followers to get used to this price action. This is a chart as of close on Friday from Kitco. And here we can see the gold was up $18.20 and silver was up 18 cents. Now compare that to the sea of red, where the Dow Jones was down 424 points, the S&P 55 points, and the NASDAQ 174. I think we should get used to this kind of thing because, again, in 2012, when QE3 came on, it all went into stocks, bonds, and real estate. And the precious metals sold off. They bottomed in 2016, even though they've gone up, they're still closer to their lows. However, the stock market and the real estate market is closer to its highs. So when we see a collapse or crash or huge correction in the Dow Jones and in real estate, it'll be a disconnect and we'll start seeing the metals move higher. So I would say start to get used to this in the future. Now, the reason why I say that, especially for silver, and I've shown updates on this chart over the past 2 months. Again, this is the COT report. It shows the commercials in red. When it's a very large number, it's a very long bar. And when it gets to the peak, that means the price is at its high. When it gets to a low, that means the price is at its low. And so over the past several years, the low for the COT commercial net short positions, as well as the price, has been about 20,000 net short contracts. Look what we have here. It's at 3,700. I have never seen that number before. This is the lowest I've seen it in decades. Now, even in 2008, when silver fell to its low of about $8, $9, there was about 20,000 net short positions. And in 2016, it was about 15,000. Here we're at 3,700. Silver is setting up to be the lowest it's ever been in years. So this to me shows that the commercials believe that the silver price is closer to its lows. They're banking that the silver price will not continue to fall from here. And we could see that. Now what I've done, this is the silver chart over the past 2 years going up and down, and I took the highs and the lows, and I showed you their commercial net short positions. Now when silver shot up in 2016 from 14 to a high of 21, there was 100,000 commercial net short positions here. Then it sold off and it went down to 74,000. When it went back up, it was even higher than it was when it was at 21. It only got up to like 18 and a half, but there was 112,000 commercial short positions. Again, when it sold off, especially when it fell all the way down to 14 and a half, in June of 2017, it went down to 40,000. And here we go again, back to its high of over 18 in September. There was 77,000. But look where we're at now. We're at 16 and a half, and the commercial net short positions are 3,700. People need to realize it's never been this low. So when we start to see the massive correction in the Dow Jones, I believe silver will outperform gold on the way up because it's set up much better than gold. And I can show you right here why that's the case. Basically, gold, their bottom is about 75,000 net short positions over the past several years. And if we look at, even though the gold price sold off, we have to remember this bar is at the end of the COT reporting period, which is on March 19th. So this does not include the 2-3 days that the price of gold really increased. So we could actually see this increase on the next report. But still, we're at 167,000 net short positions, almost 100,000 more than the minimum. So silver is actually in a much better setup than gold when we start seeing the movements higher. Again, I wanted to show you, again, one more time to compare it to gold. Look how much lower silver the commercial net short positions are. They're well below their trend for the past 2 years, and actually for decades. Unfortunately, for the oil industry and the oil price, we're seeing quite the opposite. When the oil price increased this past week, the net short positions jumped from 697,000 to 725,000. And again, because this ended on March 19th, we didn't include the price movement in oil that went up, I think, from 63 to 65. This will likely increase as well. But the low in 2016, when oil was at $30 a barrel, the low was 180,000 contracts. So let me show you this next chart of the oil price. This is when the price of oil came up from its low. This was in April of 2016. There was 260,000 commercial short positions. Now, this was trading at 35. Today, it's at 65. It's more than double, $30 more. The net short positions are 724,000. And the reason why I put it in the middle, as I stated, the end of the COT report was probably about $63. It's now at 65, so this number is going to be higher. The price of oil, which is the US West Texas Oil Intermediate, I see it falling back to 30, 40, and that's bad news. It's bad news for the US shale oil industry because let's take a look at the Permian. Now, the Permian is the new kid on the block. It's the largest shale oil field in the world, in the United States. Pioneer is the #1 operator. And in 2016, Pioneer produced almost 60 million barrels of oil. They were the #1 natural gas producer, 118 million MCF. And if we look at the charts from the US Energy Information Agency, from their monthly drilling productivity reports, the back end is producing about 1.2 million barrels a day. However, I think this number is overstated. I won't get into the details why, but it is lower than this, but this is what they're showing, 1.2 million barrels a day. The Eagle Ford is the second largest shale oil field. Even though they're producing 1.3 million barrels a day, it's still off its high of 1.7. The smallest shale oil field is the Niobrara, and it's producing about 600,000 barrels a day. And the Permian is the largest at 3 million barrels a day. So if we added these 3 shale oil fields, it would equal about the Permian. That's how big the Permian is. Now, if Pioneer Natural Resources is the largest shale oil producer, they should be making a lot of money. Well, that isn't the case. Again, this is the cash flow statement. And in 2015, according to the net income, they lost money, 273 million. It doubled. In 2016, they lost 556 million. But in 2017, they show an $833 million net income profit. Again, part of that was mostly due to the Trump tax cuts. Now, if we go down to what the net cash was provided by their operating activities, this is what they made from producing oil and gas. It was 1.2 billion in 2015, 1.5 billion, 2016, and 2.1 billion in 2017, for a total of 4.8 billion in those 3 years. Now, it shows additions to oil and gas properties. That does not mean they're buying properties. This should be stated capital expenditures to produce oil and gas. And if we look and add these up, it was 6.3 billion. They spent 1.5 billion more, Pioneer did, to produce the oil and gas than they received from operations. Now, the reason why that worked, they were able to do that, was first they sold assets, about 1.3 billion in assets. And right here, they issued 2.5 billion in stock. Now, if they did not do that, or if they did not add or sell their assets, they would have had to add a 1.5 billion to their debt. Now, this is not sustainable. They can't continue to sell assets. And at some point in time, investors are not willing to purchase new stock because it just isn't worth it. So this is a bad sign to see the largest shale gas and oil producer in the Permian. It's not making money. So the other ones aren't in any better shape. Now, I wanted to show you what's taking place in one of the large national oil companies in the world. This is PEMEX. I did publish this in one of my articles, but I just wanted to briefly explain it. This is the cash flow again. PEMEX is a Mexican's national oil company. They've got their stats in pesos, but they also show them in dollars. And in 2017, PEMEX lost $16.8 billion. Look at their interest expense. Their debt is so high, they're paying nearly $6 billion a year just to service the debt. Now, if we go down here, this is the net cash flow from operating activities. They made 2.9 billion, basically producing the oil and gas in Mexico. It cost them 4.4 billion. So this is a bad sign, and it gets even worse. This is Mexico's oil production, consumption, and net exports. The green is the important line because this is what the government makes their money. It peaked in about 2005, and it's been falling. Now, the black line is their consumption, and the gray area is their overall production. Production is starting to really fall. And so when Mexico becomes a net importer, this is the time I think the Mexican government could really start to disintegrate, because we have seen this already in the past. A perfect example is Egypt. Egypt, their consumption continued to increase, their production peaked, and has been, even though it's not declining a lot, their net exports became net imports in 2010. What's fascinating, the very next year, we had the Egypt Arab Spring, and the reason for that, when they started importing oil, prices started to skyrocket. It impacted food, the price of food. So the Arab Spring was a result of Egypt turning into a net importer. Now, people say, and you want to find the trouble, you always follow the money trail. You always follow the money. I think it's different. You follow the energy. When you start to see the energy fall apart, that's when the trouble happens. The energy is before the money. So if you follow the energy, you'll follow the problems. Now, even though I published this chart in my recent article, I wanted to discuss it again because not only are the shale oil industry is in trouble, so are the majors. These are some of the top 8 largest oil companies in the world. We have Chevron, ExxonMobil, Statoil, Total, ConocoPhillips, BP, Shell, and Brazil's Petrobras. This is the long-term debt. As the price of oil fell from over $100 down to $50, to make up for capital expenditures and even paying their shareholder dividends, they had to borrow money. Some of these companies' overall debt fell. Petrobras fell a little bit. ConocoPhillips fell a little bit. But you'll see Shell doubled. BP increased. And look at ExxonMobil. ExxonMobil jumped, and so the debt, most of the debt increased in most of the companies, and we could see it jumped by 80 billion. Now, this impacted what these oil companies must pay to service their debt. It's their interest expense. And even though, if we go back, we see Petrobras, their interest expense more than doubled. But how could that be? Their debt fell. Well, what's happened is Petrobras is paying a higher interest rate now. And we can see Shell is paying a lot more. Their interest expense has doubled. And even BP. Well, look, ExxonMobil, which is in white, they weren't paying any interest expense. Now they are. So the interest expense in just 4 years doubled or tripled from 5.7 to over 15.4 billion. Now, as the markets roll over and as the price of oil falls, it's going to be very bad news, not only for the shale oil industry, but for the major oil industries, because their interest expense, if interest rates also increase, this number will continue to increase. Look, the profits, they would have made 10 billion profits if their interest expense didn't jump by 10 billion. Now their 10 billion of their profits are just to pay debt, interest expense on debt. This is a bad sign. Now, even though I published this chart before, I wanted to just go over it one more time to show you what a bubble the stock market as well as the real estate market is. At the peak in 2007, this data comes from the St. Louis Fed. The median home price sale was about 250,000 at its peak. It declined, and now it's back up to it's up 30% from its peak at 324,000. If you watch some of these flipping shows, some of these home renovation shows, and you watch the clients that purchase these homes, you're going to see that when the market price of the home is, let's say, listed for 275,000, the sale price turns up to be 285, 288. It's higher. Most of the time, it's higher. So there's a bidding war going on. Unfortunately, when the markets really start to roll over, I see the value of real estate in the United States falling precipitously. And at some point in time, over the next 10 years, we could see a 90% reduction in the value of US residential home prices. Now, these last two charts, I just wanted to reiterate that I believe we should get used to seeing this kind of action. If the price of gold and silver in 2012 continue to increase along with the stock market, the bond market, as well as the real estate market, gold was trading, let's say, at $2,000. Silver was at $35, $40, and the market's corrected. Yes, then we could see a sell-off. Unfortunately, or fortunately for precious metal investors, we had the opposite. The metals sold off and reached their lows in 2016. And silver, even though it's off its lows, gold and silver are still closer to their lows, whereas the stock market and the real estate market is at its highs. So when we start to see much more sell-off in the broader markets, we're going to see the big disconnect this time. Gold and silver prices will continue to go higher. I believe silver will outperform gold, not only due to the COT report structure, but when traders start to see that silver is so undervalued, the percentage gains, I believe, are going to be breathtaking. Now, these are the two most important charts in this presentation. And I believe because silver is at the lowest net short position, commercial net short position of 3,700, we're going to see much higher prices. I'm not saying that's going to occur this week or next month, but over the next 1 to 2 years, we're going to see much higher prices for silver, and we're going to see much lower prices for the Dow Jones. So I appreciate you watching the newest update here on the SRS Rock Report YouTube channel. If you haven't, please consider subscribing to my YouTube channel, and I thank you very much.